Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this, you can subscribe to the channel and you can also click the bell icon so that you receive notifications for future videos as they are uploaded. Last week was flattish for the major US indices, but in two parts. The first 4 days, all the major indices went down, but there was a very strong rally on Friday, as you can see on this chart. On Friday, the Dow Jones went up by 2.15%, S&P 500 by 1.92%, and Nasdaq by 1.79%, possibly as the probabilities of a 100 basis points rate hike in July diminished. Now, we should remember that this was a two-part story because in the first 4 days of the week, the markets went down as we saw a hotter than expected CPI report. In fact, the highest US inflation rate in 40 years. Technicals look interesting, as you can see in this chart of Nasdaq. We've been talking in the past about a declining trend, and you can see on this chart as well that the Nasdaq has been declining since the beginning of this year and has been witnessing lower lows and lower highs. However, at the bottom of this chart, you can also see that starting mid-June, there is a newer trend of higher highs and higher lows which has emerged. Right now, the Nasdaq seems to be hitting against the 50-day moving average. That's an interesting technical setup for next week. It'll be interesting to see whether the Nasdaq pierces through the 50-day moving average, in which case it'll be a change in trend, or it falls back again as it has done on other occasions this year. In crypto markets, the news was again flattish. Bitcoin kept trading between $19,000 to $21,000, and ETH was flattish again between $1,000 to $1,200. In terms of crypto company news, the major news was Celsius, a crypto lender, filing for bankruptcy in a New York court. Celsius had frozen all withdrawals from its platform in June, citing extreme market conditions. They've now filed for bankruptcy, and this is another example of a lender that was offering very high yields, almost 17 to 18%, for whoever who was contributing tokens to be lent further to borrowers. This is very similar in that sense to the Terra Luna story, and the collapse therefore is also not very surprising. The biggest news of the week actually was that the euro achieved parity against the dollar for the first time since December 2002. The euro was born on 1st January 1999 at about 1.17 to a dollar. It started going down immediately thereafter as the US economy was very strong, but there were also concerns on the structural nature of the euro because it was a monetary union without a fiscal union. It went down below the dollar for the first time in December 1999. Kept going down to reach a low of about 0.84 to a dollar, as you can see on this chart, and then began to climb back up. It gained parity to a dollar in December 2002 and then became higher than the dollar. Remained like that for 20 years and now has, for the first time, reached parity to a dollar. So quite a major event, and this is probably driven by weak European economic conditions and the after effects of the Ukraine-Russia war. Actually, 2022 has been tough for most major US currencies against the dollar. As you can see on this chart, the euro has declined, but so has the British pound, the Japanese yen, and there are other currencies that have declined, be it the Canadian dollar, the Swiss franc, or the RMB. In fact, the worst performing currency has been the Japanese yen, which has declined about 17% to a dollar since the start of this year. Interestingly, the one currency that has done better than the dollar and has increased in value is the Russian ruble. Now, the US dollar is actually on a 5-year high, as you can see on this chart. Its pace of increase has also been very, very rapid, driven, as we can guess, by the change in the monetary policy stance of the US Fed. So as the Fed funds rate increases, US treasuries become more attractive, and there is more dollar inflow into the US, and therefore the US dollar strengthens. That's what we are witnessing on this chart. But this is a tremendous headwind for all US companies who have major global businesses, because then their earnings for non-US businesses are lower in dollar value, and therefore their total earnings are lower. We should expect a big impact of a high dollar on earnings of companies with major non-US businesses, be it Apple, Google, Tesla, Starbucks, etc. The other major news which was important to note this week was a very strong US CPI report. In fact, US inflation was at its highest level at 9.1% in the June reading compared to 8.6% in May. While a lot of this inflation is driven by energy, which is up 41.6% for the last 12 months, and food, which is up 9.1% for the year. But the growth is broad-based because the used cars and trucks price index is up 7.1% and the shelter index is up 5.6% for the last 12 months. So broad-based US inflation. The core CPI did come down at about 5.9% in June compared to 6% in May. However, what's known as the sticky consumer price index, which is including a subset of commodities in the overall basket that CPI comprises of, but those commodities whose prices change less frequently. Now, this index kept going up and reached a high of 5.4% in June. Now, because the prices of commodities in this index don't change that frequently, this is considered to be a better predictor of future inflation expectations. And if it is at 5.4%, we are not returning back to a 2% inflation regime anytime soon. What does it mean overall for the Fed and the overall economy? Well, I think the Fed is trapped. In fact, in June, the Fed had planned for only a 50 basis points Fed funds rate hike. However, hotter than expected inflation number forced the Fed's hand and they had to go for a 75 basis points rate hike. In July also, a red hot jobs report followed by a hotter than expected inflation report means that a 75 basis points rate hike is locked in. I would be very surprised if on 27th July, the rate hike is not 75 basis points. Now, what that means is that from May to July, the Fed funds rate would have increased by 200 basis points. That is massive. The pace of change actually creates trouble and breaks something in the market. Because imagine many companies were actually operating in a very different paradigm when capital was cheap and easily available. Now suddenly, cost of funds have gone up. These companies have taken large amounts of debt. These debts are getting repriced and many of these companies will struggle to pay their interest or pay back their loan. And in these conditions, bankruptcies emerge. And evidence of a tightening liquidity environment is actually the sharp decline in the spread between the 10-year minus the 3-month rate. It is now at 56 basis points, as you can see on this chart, and has come down dramatically from 220 basis points. That was the number in May this year. If the Fed hikes 75 bips in July and does another rate hike of 50 basis points in September, I wouldn't be surprised if the 10-year minus 3-month rate inverts. So we should expect tighter liquidity and more skeletons to emerge, not just in the crypto world, but in the broader economy as well. There might be other areas of stress, especially in auto delinquencies and layoffs and increasing weekly claims numbers on an ongoing basis. What does this mean? This means that tougher economic conditions will continue to remain. Fed's hand is forced. Something could break given the pace of Fed funds rate hike that we are seeing. The only positive that I can see from this is that the moment the market sniffs that something is breaking and the Fed is going to reverse from its hawkish monetary policy stance, it will rally in anticipation. Thank you.